After the session break, we are again in the company taxation question in the pilot paper. Then I have explained the before this session in the previous one. The now main focus is for us is to look at the how we are going to provide capital allowances and how to compute balance in allowance or assessable charge, and after that the leasing allowance. I need to focus on these these three areas now very critically. Okay, this is very important. That's why I have stopped here and separately taken this explanation. Now we will see the computation of the capital allowances. The first focus is that capital allowances. Capital allowances, in here in capital allowances, what is the sections of that? Section 16 plus 4th schedule to act. 4th schedule. Other than that, I need to highlight your focus for other than these two, the transitional provisions gazette notifications. Transitional provisions gazette notification. Gazette notification. Transitional provisions gazette notification. Then here these are the three key things you should know. Now we will see what are the important aspects of this. Capital allowances, I am taking a one part here for the freehold assets. Freehold assets, then freehold assets. I need to take the next part for the leasehold asset time being. Then freehold asset, then freehold assets acquired in different time gaps. The acquired on, we will take first acquired prior to 1st April 2018. What is the tax, the capital allowance treatment, and acquired on or after 1st April 2018. This is very important. On or after and prior to. Why these two time gaps? Why these two time gaps? Because the act number from this period, we had Inland Revenue Act number 10 of 2006. In this period, we had the new, we are using at Inland Revenue Act number 24 of 2017. The two Inland Revenue Acts, that's the reason. That's why we are having a transitional provision gazette. One act to change into another act, then under that circumstances, what happened to the areas continue with the previous act to the new act. That is the important aspect. Under that, the one area continue with the previous act to new act is the capital allowances, or rather in the old act we have the use the name in the depreciation allowances or allowance for depreciation. These are the two acts, these are the two periods. What is mentioned in the transitional provision gazette? In the section 203 in the act and the gazette notification specify the regulations in that Inland Revenue Act number 10 of 2006 is continued to apply till the end of the useful lifetimes of this particular assets. Then what is the message going to you? You should know the depreciation allowance rates which we have applied under Act number 10 of 2006. In that, for an example, furniture and fittings and motor vehicles other than travelling purpose vehicles, furniture and fittings, it's 20%. motor vehicles 20%. Then if we have checked the equipment, it's 33 1/3, or it's totally 3 years. Now for this, for an example, take this furniture and fittings. If this is acquired in 2017-18, you have to apply the first year 20%. Can you change after that to this act? No, you cannot. You have to apply the second, third, fourth and fifth years same 20%. 20% continuously till the end of the useful lifetime of the asset. I think it's clear. That's the link to the transitional provision. This is a one part. And second part, under new act, what happened? New act, we don't have capital allowance rates. We are having number of years. We are having number of years. Then we are having categories of assets, class of assets, class 1 to class 5. Under that, we need to take the number of years. Number of years, 5 years, 20 years, and for the intangible assets, actual useful lifetime, if we can quantify that, if not again 20 years. Here 20 years, this is for intangible asset, as I have explained. Actual useful life, if we can quantify, then we need to go for that one, if not 20. This 20 years for the buildings, 5 years for all other. For my easy reference, I am using all other machinery, motor vehicles, then the furniture and fittings, equipment, everything. Please go through 4th schedule to the Act and refer this this number of years. That's the first thing I need to highlight under this freehold assets under transitional provision. Transitional provision and the 4th schedule and the 6th schedule. Now I need to take the disposal adjustment. Disposal of the freehold asset, and maybe freehold assets we have two parts. One is the capital allowances we have given and capital allowances not given. Capital allowances not provided and the capital allowances provided. Then I am taking the example of the how capital allowances given depreciable asset, which we have given capital allowances, it has disposed. Now what's the treatment? In that, the very easy, we need to take the sales proceed, then less tax written down value. Tax written down value. What is the tax written down value mean? It is cost minus cumulative capital allowances claimed. Cumulative capital allowances claimed. For an example, we will take the sale proceed. I have disposed this furniture which I have brought in 2017-18 after using of the 3 years period. After using of 3 years period, now I am in the 4th year, I have disposed this. Assume like that. Then cost, we will assume that cost is 100,000. Then this we have sold it to 80,000. We will assume that. Then cost is 100,000. Capital allowances claimed. Then please stick to your mind, the year of disposal is not not eligible to claim capital allowances. Year of disposal is not eligible to claim capital allowances. Therefore, we have to take cost 100,000. How many years? 1, 2, 3. 3 years we have provided the capital allowances at the rate of 20% and the 3 years. Cumulative capital allowances claim, which is 100 divided by the 5 years, 20 mean 5 years, and into 3 mean it is 60. Then 60,000, this is 80, and 100 minus 60,000, then my tax written down value is 40. What is my taxable profit? 40,000. Taxable profit charged to the income tax is the 40,000. I think it's clear. Now, is this any change of the computation of disposal of the depreciable asset under Act number 24 of 2017? My answer is no. The same basis, unless if the only thing is it's using number of years. Then I am taking this same method of calculation. The same method of calculation on disposal of depreciable asset. The definition of depreciable asset has provided in the Act. Then please go through that. It's given in the fourth schedule as well as it is the capital asset definition, all these things in the section 195. Then this is the calculation same, other than for this period we are applying the rates, for this period we are applying the number of years. Then this is the total part of the capital allowances. Now, even the calculation method same, the name used for this wordings, the wording has changed. What is the change? We may have balancing allowance, and we may have assessable charge. Assessable charge in your language, this is tax profit on disposal of depreciable asset. Balancing allowance is the loss from the tax loss. If there is a tax loss on disposal of depreciable asset. Okay, then this is done. Next part I need to take you all through is the leasing asset. Assets acquired under finance lease agreements. Assets acquired under finance lease agreements. Again, I am dividing this to two components. The one is finance lease agreements entered prior to 1st for 2018 and finance lease agreements entered on or after 1st for 2018. This is very easy. This is very easy. Finance lease agreement entered prior to 1st April 2018. What is the tax treatment? This tax treatment continuing under new act also for the finance lease agreement entered prior to 1st for 2018. Tax treatment, finance cost or the lease interest cost. Finance cost, I will use the name as a lease interest cost. It's easy for you all. Lease interest cost. This is disallowed. This is disallowed. Then leasing allowance. Leasing allowance, we are calculating on how to calculate leasing allowance, 1/5 or 1/4 based on the asset category. 1/5 is for the vehicles, furnitures and machinery, 1/4 for the calculating equipments and the IT equipments. 1/5 or 1/4 of lease value. Take the answer. Lease rentals paid. Lease rentals paid for the year. We will take this as 100, this as 80, then whichever is lower. Whichever is lower, that means 80, we are claiming this as the lease rental allowance, leasing allowance. Then be mindful in the assets acquired prior to, sorry, not the asset acquired, the correct wording is lease agreement entered. Lease agreement entered prior to 1st April 2018. This part, this we should provide still till the lease agreement ends, maybe 5 years, maybe 6 years, till ends. We are using this part as the under the what, under transitional provisions. Then we are using the lease rental allowance. Lease rental allowance. What happened after that? Can you remember when explaining the first mind map in the computation of taxable income? I have told about section 39. Section 39, in that I have mentioned the leasing is the only way of finance, not it is asset category. It's defined in the Inland Revenue Act. Then in that sense, finance lease agreement entered on or after 1st April 2018, what happened? You shall provide what? Capital allowances. It is the only way of finance. The asset is used by us. Then after agreements, it's our asset. It's owned to us. Then we must provide capital allowances. How to provide capital allowances? Based on the rates given in the years, number of years given in the 4th schedule. Then what happened to finance cost? Finance cost, or yes, I am using the word finance cost. This should be subject to section 12 and 18. Section 12, you should need to look at whether this finance cost is allowable, which is incurred for the production of income, or used for the asset, the acquired asset used for the production of income. And then section 18, the restriction on finance costs for the manufacturing organizations separately, the non-manufacturing organizations separately, and this finance cost is under the restriction of the finance cost under section 18, share capital plus reserves into 3 times or 4 times other than the revaluation reserve. Now, this is the entire picture. What I need you to highlight under capital allowances on 2 categories of assets, freehold assets and the assets acquired under finance lease agreement. And one important thing I need to highlight here, the travelling purpose motor vehicle. Travelling purpose motor vehicle. Think the travelling purpose motor vehicle, no capital allowances, disposal gain, disposal, if there is a disposal gain, it's out of scope of the act. Out of scope of the act, we cannot tax that. We cannot tax that because that asset category is not under the capital asset definition, and it's not under the definition of the 4th schedule as the commercial vehicle. Then it's totally out of scope. Any loss, gain we cannot tax any loss, any disposal loss. Disposal loss we cannot deduct. We cannot deduct. This is the entire picture which I need to provide for the additions, disposals, claiming of capital allowances on freehold assets as well as the leasehold asset. Please have this mind map. It may be grey, it may be not clear, my handwriting, but please have this. This is help you to take the at a glance picture of what is the treatment. With that understanding, we will come for this part. Then on 20th December 2019, Pinnacle PLC disposed of 2 pool motor vehicles which were used only for the business travelling and transport of staff. The details are as follows. Motor car and motor van. Now you all know motor car, it is acquired in 1819, motor van 1516. What now you all know? Motor car we cannot the maybe gain, maybe loss, we cannot tax that gain, we cannot deduct the loss, and the motor van 1516 we must apply the transitional provision, the previous tax rates, and we need to compute the gains tax gains and losses relevant for the tax purposes. Then we will go for the answer. In the answer, now see, when explaining the format, I have told you all the workings if relevant, if necessary, if you have enough space here, please do here, because it is easy for you as well as the marker to mark your paper. Then first thing we need to add it is the accounting profit from disposal of PP&E. We need to eliminate that first. We need to eliminate that first from the business income. Now where it was in the other income. I think in the other income first item, profit from disposal of PPE, then it should be removed from the business income. What we have done is correct. Then we need to compute the assessable charge or balancing allowance. I have used this wording to you to familiar with this wording. Then motor car purchase in 2018-19, the way of calculation I have explained. Now we will go for the answer. Sales proceed, it is given in the question. The sale proceed for the motor car separately given in a note of the question, which is 17.34435, and the cost is 15 million, and the motor van in the 1516 cost is 10 million, and the sale proceeds also 10 million. We will see the how to calculate the assessable charge or balancing allowance of these two. Now sale proceed from the motor car 17,435 cost, and do we have capital allowances? No. Why? For the travelling purpose motor vehicles we are not claiming capital allowances, then we do not have the cumulative capital allowances claim. In that, see my special note, capital allowances not applicable since this is travelling purpose motor vehicle. If you can write this, the explanation point is much more benefit to you all. Then gain received from disposal of motor car 2,435. Is this taxable? No. Then this gain excluded from IR Act number 24 of 2017. I have explained it very clearly why travelling purpose motor vehicles not eligible to give capital allowances. It is out of scope of the section 16 and the 4th schedule. It is not included in the definition of the commercial vehicle. and very especially the motor cars, even in the capital asset definition, it is not included. Therefore, in the Act we don't have any place to tax this amount. Then this is the excluded. That's why in the answer I have not taken single amount as the tax. Then motor van sale proceed the 10 million and the cost is 10 million. Now we need to look at cumulative capital allowances claim. What is the rate? 20%. Then this has acquired in 2015-16, 15-16 1 year, 16-17 second year, 17-18 third year, 18-19 fourth year. Then we are in the year of assessment 19-20. For the year of assessment which we are disposing of the asset, can we claim the capital allowance? No, we cannot. Then cumulative capital allowance only 4 years. That's why cost of the 10 million into 20% into 4 years, assessable charge is the 8,000. How it came? You can see the formula. It's the cost minus cumulative capital allowances claimed. Then this is the cumulative capital allowance 8,000. Then we are ended with this answer. I think it's clear. It should be crystal clear to you all. Then we will go for the next adjustments. We will go for the next adjustments. Then here next one, it is to be assumed that the market value of the small limited shares as at 30th September 2017, which were disposed of during the year, was equivalent to the actual cost of those shares. Why this kind of assumption needed? Why this kind of the assumption needed? If you can remember, we are having the investment asset. Under the investment asset, from the investment asset we are receiving the investment income. That investment income comprised in two parts: gain from the realization of investment assets and the income from investment activities. When it comes to gains from realization of investment activities, when it comes to gains from the realization of investment activities, the calculation is very, very important. The calculation is very, very important. In that calculation, I will summarize little bit because it's again linked to the transitional provision section 203. Then computation of gains from realization of investment asset. Sales proceeds less cost of the asset. How to determine the cost of the asset? It's very, very important. How to determine the cost of the asset? The determining factor for cost of the asset, if the asset acquired, I am using this is asset mean investment asset. If the investment asset acquired on or after 30th September 2017, then take that cost. If the investment asset acquired prior to 30th September 2017, now there is an issue. What is the issue? We need to take the valuation as at 30th September 2017, and this will be my cost of the investment asset. this will be my cost of the investment asset. Therefore, that's why in your question, the examiner very clearly given, it is to be assumed that the market value of the small limited shares as at 30th September 2017, which were disposed during the year, was equivalent to the actual cost of the shares. That means that the sales proceeds and the actual cost, there is no any difference. It's very clearly given. Then what's the reason for that explanation? This section 203 transitional provision, the relevant provision in the Inland Revenue Act. Now, if I have continued with this, then the cost minus, and we have to less again incidental expenses. Incidental expenses of acquiring and disposal, for both acquiring and disposal of the asset, that's expenses. What are those? Advertising, transferring taxes, duties, brokerage, all these things. Then we are taking the answer of the gain or gains from realization of investment, as it's understood. I am not repeating that line again. Then my question is that shares are the investment assets. Why I have explained this thing on the investment, the shares, for the adjustment for the shares? Because yes, shares are investment asset. How am I telling it's an investment asset? Because it's in the definition of the investment asset in section 195 very clearly, the membership interest. Membership interest is the part of the investment asset. In that membership in the section 3 very clearly given membership interest in the it is shares for the company. Then in the section 3 it is given the gains from realization of quoted public company shares exempted, but private limited company shares liable. Now all the information you all know, we will go for the answer. Before answer, we will see what is the figure in the other income. In the other income, gains on realization of quoted public company shares, it's exempted. Gains from disposal of investment in small limited, 600,000. 600,000 it is. It is here, it should be, this is gain on disposal of investment in small limited. Why it's removing from the business income, consider as investment income in section 7. It's not the part of the business income. Then it has removed first, then we need to compute, for the investment income, what is the treatment. That's why I am repeating the importance of the formats. Then in this is my investment income part, Pinnacle PLC, TIN number, schedules to tax computation for the year of assessment 1920. Schedule 2, computation of assessable income from what? Investment, rupees thousands. Then in that, is schedule 2, schedule 2.3, what's the main heading? Gains on realization of investment asset. In that there is a land, and second one is the shares. See how I am the benefiting out of the formats to my time allocation. Shares, gain on realization of quoted public company shares, exempted income under third schedule item H. Third schedule item H. Again I am telling you need not to write for this extent, but at least write exempted under third schedule. If you can remember this item and all, please write. Then it is not form part, since it is exempted, we cannot tax that, then it has not come to the summation columns. Then see, gain on disposal of investment in small limited, it was assumed that accounting profit equivalent to tax profit as the value at 30th September 27 is equivalent to the cost. Then accounting profit also 600,000, the tax profit also 600,000. We have discussed that part. Considered under investment income as well as removed from the business income. Done. Then the next part, the next adjustment, the rent income consists of two components. LKR 730 billion from renting out extra space of company building and LKR 270 billion received from telecommunication companies in respect of the use of telecommunication towers erected on the rooftop of the headquarters building located in Colombo. Withholding tax on this payment has been deducted by the withholding agent. Now, what is our main business? The manufacturing of engines, maybe the engines for boats and the providing of repair services. Then this is extra space I have rented out. Then this is my investment income. Can we include this under business income? No. The first adjustment we need to eliminate. This is from the business income. Now, if I have go for the other income part, rent income is there. Rent income net 900,000. Then in our calculation, we need to eliminate that amount from the business income. That's the first adjustment. This one, rent income, part of the investment income under section 7. We have done that. Then meanwhile, we need to go for the investment income under investment income note or schedule, rent income. This is gross rent income from gross building rent and the gross telecommunication tower rent. Please note that in the business income, it is in the net 900,000. But when it comes to investment income, we need to gross up it and we need to take into the investment income for 900,000 is a net. It's divided by 90 into 100. The gross rent is a 1 billion. Since this is 1000, it's a 1 million. Then what's the difference between 900,000 to 1 million? Is 100,000. What is that? Non-final withholding tax on rent. What is that? It's a tax credit. See, if you have this format, then you can immediately go for the tax credit. In the tax credit, WST on rent, see. 100,000 we have claimed. The entire adjustment with relevant to the rent we have done. The elimination from the business income, recognized under gross rent in the investment income and the claiming of withholding tax credit. Done. Then we will go for the next part. In the next adjustment, during the financial year, the company received the compensation and interest on late payment of compensation for acquisition of the bare land adjoining to the factory, kept as an investment asset in the company from the Land Reclamation Commission on behalf of the Road Development Authority in 2015 for the construction of the Colombo Outer Circle Highway. Okay, now we are in the story of the investment income. Now, there is a land. Is it combined to the factories? No, this is a bare land, isolated land we had. Then in that sense, is this part of the business land? No. This is not the capital asset of the business. This is a separate land which we kept. It is going for the outer circular project, the OCH. Then what happened in this, it is my bare land. If that land has gone, we don't have any impact to our business. Then this is investment as very clearly in the question examiner has provided. You don't have to think even you don't have to analyze like I have done, but for your explanation I have done that. In here very clearly given investment asset. Now you know if there is an investment asset, can I apply the company tax rate of 28%? No, we have to apply 10% if there is a gain. Okay. Then the government paid the market value of the land. As of the date of the payment in 2019, the open market price of such land as at 30th September 2017 has been calculated as LKR 500 billion. Very clearly all the information provided. Then you need to compute gains from realization of investment assets. What is the investment asset? It's a bare land of the company. Then first thing, now we know it is the investment asset. Then we need to eliminate that first from the business income. That's why I have done this. See, compensation from land reclamation commission, investment income under section 7. We have removed the gain in the income statement and the other income. Then sundry income, then this one has removed first. Second one is there is a interest received on LRC on compensation of land, which is under again interest. It is part of the investment income under section 7. Both these things, the 750 billion, it is included in the question under the other income part. As you can see, compensation on land acquired by land reclamation commission 700 and the interest received 50,000. Both the adjustment we have done first, it is elimination from the business income. Now we will check how this is liable under investment income. Go for the investment income. Now it is given sale proceed of land investment asset. Very clear, it's a 700,000. Why? In the note it is provided. What is the note? If I have repeated that note, if I have repeated the note number 7, the government paid the market value of the land. Government paid the market value of the land. That's mean total amount I have received, it's in my other income. What is the total amount? It is 700 million. Then it is my sales proceed. We have took that. In the examiner very clearly given what is the value as at 30th September 2017, and you are very clear to compute the gain on realization of investment asset, which is 200,000. We have done that part also completed. Now what's going to your mind? Now there is a capital gain of 200,000. There is a capital gain. Do you have to pay the tax on this transaction on 2019 December? Yes. Why? As per the provisions of the Act, as I explained in my initial session outline, there is a gain, the capital gain tax we shall pay within 30 days of the transaction. Within 30 days of the transaction. Then what is the rate? 10%. We are having the gain, we know the rate, then it has paid. If it is paid, what is my tax liability? 20,000. In 1,000, it's 20,000. Then it is my what? It is my tax credit. Capital gain tax at 10% on land acquired by LRC. It's a 200,000 at 10%. 200,000 and 10%. The same thing is applicable to capital gain at 10% on disposal of shares 600,000 at 10%. These things, if you know the provision, you can fill these things very urgently and immediately you can do these things. Okay, then we will go for the next question, next part of the question, which is the sundry income. The sundry income of LKR 150,000 represent the money received from a boat engine manufacturing competitor. We have received the money from the competitor for not making tender application for financial years 2019, 20 and 21. How nice our competitor. To supply certain capacities of both engines that are supplied by the competitor to the government of Sri Lanka. There is a tender. My competitor has given a money to me for what? To don't send the tenders for this. What is this? What is this? This is very clearly in the section 6G. This is my business income. But you see, examiner is very clearly given business income relevant for the financial years 2019, 20 and 21. Can we take 20 and 21 for our period? We cannot. Then only applicable part is 19, balance part we have to remove. This is part of the business income but not the all. Where this was in the paper, this is in the other income. In the other income under the sundry income category, this 150,000. Then we will see the what is the adjustment we have to do on this. Then we will go for the answer, and in the answer business income calculation, see sundry income, this is first one sundry income, part of the business income as per the section 6 2E. I have earlier mentioned G, it's not G, it's E. Then no adjustment required because it's a part of the business income, which is restriction of the capacity to conduct a business. I have used the extract wording in the act. Then balance second adjustment, I have removed the 100,000. Why? Why I have removed? Is it not part of the business income? No, it is part of the business income but it is not relevant to our period. Then sundry income, business income received for financial period 2021. We don't know what is the extract amount. Then we have put the assumption 150,000 into divided by 3 years. Assume that received equally for 3 years. These kind of things are really important. Why to you to put the assumption? Because examiner cannot, the marker cannot read your mind. Then you should write. Then since you have wrote this, assume that received equally for the 3 years, then 100,000 is removing from the business income. I think it's very clear to you all. Now we will go for the rest of the adjustments. Then in that, the allowance paid to managerial staff amounting to LKR 13.8 has not been considered for PAYE tax. Nothing to think even. This should be disallowed. Why? Under section 10 subsection 2, any payment which subject to withholding tax or which withholding tax would have to deduct. If it is not deduct, it should be disallowed. Then in the here this allowance paid to managerial staff 13.8, it is disallowed under section 10 subsection 2. Section 10 subsection 2. Now we will mark those we have discussed. Okay. Then again we will go to the paper, the next adjustment. Now the allowance paid to managerial staff, we will see where it is in the paper. it is here, it is allowance paid to managerial staff 26,008. In that 13.6 disallow, it's assumed that balance is the allowable. Then next one, operating lease rentals consist of payment made to heavy vehicle supplier who provided motor lorries with drivers to transport engines on which the WHT has not been deducted. Again, WHT has not been deducted. Then actually this is maybe new to you all, shall be new to you all. This, if the WHT has not deducted, our view is it should be disallowed. This is the transport vehicle used for the transportation service, but the Department of Inland Revenue has issued it's a public ruling. We are having a public rulings and private rulings. Then in that, this is a issue to the public, to the all public. The ruling has issued, it's like a guideline we need to follow, but don't fear, maybe students think that how these things we know. It is, don't worry, it is at least it's good to know these things from this paper itself. It's really good to know these things, and if you know these things, the application part is really easy. Then there is a public ruling. According to that public ruling, if there are vehicles used for the transportation purpose, if the driver and fuel has given by the owner of that vehicles, then it is not subject to the withholding tax. Why this kind of a provision were there? Because if we have gone for the section 195, the definition of rent, in the definition of rent is given rent is any kind of rent. Given the outright or the right given to other, it is any kind. But that's why since it is any kind, there is a question. Any rent is subject to withholding tax. That's why this further interpretation has given in the way of the public ruling. We will see the public ruling, not the public ruling, but in my answer I have included that it is operating lease rentals on heavy motor lorries used for transportation of engine, allowable deduction. Non-deduction of WHT is not applicable due to the provision of transportation. Then what is the assumption and the all information I have provided to you? As per the public ruling number PR IT 2018-02 issued on 2nd May 2019, since the driver and fuel is provided by the vehicle owner and respective vehicle remains in the possession of the owner, this is considered as provision of transport service provided by the resident individual and not subject to WHT. The clear comprehensive explanation I have provided, therefore follow that in here. Therefore it is not a disallowable item or disallowable expense, even it is not subject, even it is in the question it has given no WHT has deducted. See, it's the operating lease rentals of motor vehicles. We have done that part also. Then next adjustment, gratuity paid during the year 2019-20 11.2. Is it coming under income statement? No, it is in your financial position gratuity note, which is retirement benefit obligation note. Then this is allowable deduction. Why? This is incurred for the production of income, and also the provision has disallowed. Then in my question, in my answer, gratuity paid section 11 allowable deduction, which is 11.2. Done. We will go for the next adjustment. according to a statement of the financial position prepared for the year ended 31st December 2019, the following capital assets are available with the company which entitles to the claim and allowance for depreciation for the year of assessment 1920. Very easy. Machineries acquired in 1819. What is the number of years? 5 years. Forklift, finance leases, that's the thing. It's given 1718. If the finance lease agreement entered prior to 1st April 2018, can you provide capital allowances? No. You must provide what? Leasing allowances. Then motor car. Motor car, what is the treatment? Is acquired in 1718. Can we claim capital allowances? No. In the earlier act and the new act, both travelling purpose motor vehicles, we cannot claim capital allowances. Office equipment acquired in 2018-19. How many years? 5 years. Computers, finance lease. See, finance lease for what year of assessment? Entered in what year of assessment? 1920. Then it is capital allowances we can claim. Computer software 5,000. The actual lifetime of computer software is estimated as the 5 years by the company. Then it has, why it has given the 1920 this acquired. If this considered as the intangible asset, then the actual useful lifetime or 20 years we have to take. Now actual useful lifetime is available. For the 20 years we are going, since the actual useful lifetime is not available, then the actual useful lifetime is there. Then therefore we can apply the 5 years. Now we will go for that capital allowance part. Capital allowances section 16 for schedule to act and the transitional provision gazette. This I have given for your reference for the examination, no need to write all this. Then machineries purchased in 2018-19, it's 88 million divided by 5 years, 17.6. And second one, see the forklift. In the forklift I have given finance leases in 2017-18, therefore leasing allowance shall be claimed as per transitional provision. I have explained this. Motor car explained, not eligible for capital allowances. Building purchase in 18-19, it's 20 years, then 60 million divided by the 20 years. We have done that. Then next part, office equipment purchase in 2018-19, the number of years 5, then it has adjusted accordingly. Then next one, the computer acquired under finance lease on or after 1st for 2018, it's eligible for capital allowances because it's a lease agreement entered on or after 1st April 2018. Then computer software purchase, it's 5 years, it has given and I have explained it separately. Done. Capital allowances completely done. Balancing allowance we have done. Assessable balancing allowance no calculation, but the assessable charge we have computed in the earlier 8,000 on the van. Done. Then the next part, now the forklift given. Forklift is given in the latter part, but we will go for next adjustment. Travelling allowances including 13.4 paid to non-executive employees which are considered not liable for pay tax purpose as their employment income is below LKR 100,000 per month. The balance consists of official travelling expense. Then no need, because the pay liabilities arising above 100,000. If it is below 100,000, does the Pinnacle PLC has a right to deduct? No. Then can we disallow the relevant WHT has or relevant PAYE tax has not deducted? No. It has not relevant. Therefore, this is an allowable deduction. We will go for that part. Travelling allowance, PAYE tax not deducted. Allowable deduction since all employees are below the threshold of PAYE tax deduction. Done. Then next part of the paper, if we have gone for the expense, it is allowance for managerial staff are there, salaries and wages are there. For that, this explanation has given. The foreign travel cost incurred to visit Europe and the USA for participating in exhibitions to demonstrate newly manufactured solar engines was successful, and the company received new business opportunities to enter Europe and USA market in the financial year 2020. Then even the benefits goes to next financial year. Under section 11, main deduction rule, what is this? This is expenditure incurred for the production of income. Then this should be an allowable deduction, okay. Then therefore, it should be, it is allowable, no adjustment required. We will see foreign travelling expense, allowable deduction, section 11(1). Why it is allowable deduction? It's a business tour. Next one, Pinnacle PLC has incurred LKR 800,000 to replace the motherboards of 16 computers damaged due to high voltage of electricity. The said computers were purchased under the finance lease agreement made during the year 2019. If you have gone for the fixed assets, in that computers finance lease, what is the cost of the computers? 4 million. Year of assessment 2019-20. What happened to that computers? That computers damage and repair has done for LKR 800,000. Why this adjustment has given? To apply the repair and improvements, to apply for repair and improvements. In that sense, we will go for that. Then repair and improvement, repair cost of motherboards of 16 computers purchased in 2019-20. What is the adjustment? What is the adjustment? Before come to this, I will explain the adjustment to you, and next I will come to the Excel answer. First we will see how we are going to compute that and the what is the treatment and all. We will see. And after that we will come to our answer. After that we will come to our answer. Then repair and improvements. Your adjustment, which is section 14. This is specific deduction. It is, I am using R&I, the repair and improvements. In this repair and improvements, there are two rates. What is the meaning of now? The students. The students, what they are doing, they are mix up this with the maintenance. Therefore, I need to explain again not only the repair and improvements, but also the maintenance. What is the meaning of maintenance? In the section 14, no word in talking about the maintenance, but we are having for the assets, we are having repair, maintenance and improvements. This is a 3. What is the meaning of maintenance? Maybe under maintenance agreement, my computer maintenance. There is the so-called company to maintain my computers. They are coming 2 months, for the period of 2 months they are coming in. As per the agreement, they are servicing my computer. This is allowable deduction. This is allowable deduction. Then next one, repair. What is the meaning of repair? To use the asset under existing condition. For an example, in my photocopy machine, one of the drum has gone. If so, without drum, I cannot use the photocopy machine. To put that drum here, that means to asset to use the existing condition. Asset to use the existing condition. Existing conditions, we need what? We need repair. Now this section 14 talking about one is repair. Second one is improvement. What's the meaning of improvement? Meaning of the improvement is, it's a something, a capital nature thing. Maybe land improvement, but I have given this as the example only. Land is not a depreciable asset, and maybe there are leasehold improvement, maybe for vehicle we have done the improvement. Likewise, maybe building, very particular thing. In the building we have done the improvement. Then as a student you have to look at whether this improvement is capital or revenue. If this is capital nature, then it should be added to the depreciation basis, or as addition. In the accounting terms also it's addition, then it separately goes. Clear? Then the issue is the repair cost. Improvements more or less is not coming to the income statement, but the repairs are coming to the income statement. If it is so, we need to take the what is the tax treatment for the repair. I think it's understandable. Then we will see how we are giving a percentage as the allowable expense for the repairs. Then the 5% and the 20%. 5% and the 20% of repair. These percentages given on what? Given on previous year of assessments, tax written down value. Previous year of assessment, tax written down value. The 5% is applicable, the 25% is applicable to the buildings and permanent structures, and 20% is applicable to all other asset categories. All other asset categories. Okay. This is the biggest picture of this. Now, we need to check what happened to these 16 knots computers. Then you have this information. Now we will go for how we are going to calculate. Actual repair cost 800. Where I have take this information, the actual cost I have take from the expenses C, repair to computer purchase in 2019. It is the actual cost, then actual repair cost is there. Now 20% has came how? Under section 14, other than building, all other assets, we need to check 20% of tax written down value as at the end of the previous year of assessment. Then section 14, subsection 2, A Roman 1. Now, this is acquired in 1920. Do we have previous year tax written down value? We don't have, it's 0. That's why no tax written down value for previous years of assessment, since asset has acquired in 2019-20. Therefore, unfortunately, full repair cost disallowed. Allowable repair cost is 0. Disallowable repair cost of 16 computers 800C, it has disallowed. Is this the only adjustment we have to do? If you did only this adjustment, you are receiving half a marks. To get the other half marks, you have to see impact to the tax written down value on the repair and improvements. In section 14 and the 4th schedule to act, very clearly given depreciation basis of the asset. Depreciation basis of the asset is the tax written down value plus any repair or value added to it. It's very clearly given amounts added to the tax written down value. This is amount added to the tax written down value. This should be added to the depreciation basis of these computers. And next year, what is our next year of assessment? 2021, we have to compute the depreciation, the capital allowance based on the depreciation basis after adding this amount of the 800,000. See the adjustment impact to tax written down value in 2021. You shall do this adjustment. It is compulsory to do. Cost of the asset 4,000. The 16 computers, I have taken it from your PPE note. Less capital allowances came in 2019-20. Tax written down value before repair cost 3,200. Disallowable repair cost in 19-20 800. Tax written down value after adding repair expense 4,000. In 2020, capital allowances are calculated on rupees 4,000. That means 4 million according to the 1,000. Okay, I think it's clear. All the adjustment requirements, rates, asset categories, how calculate, what are the other treatment, explain. Then go for the next adjustment. Next adjustment in the paper, we were in repair expenses. Then we are in the last adjustments of the paper. Then the provision of impairment is computed of an amount of LKR 8,080,000 made for individual impairment for specific doubtful trade receivables and the balance for collective impairment. Now see, what is the amount of impairment in the income statement? In the expenses, provision for impairment 16,080. Now examiner has given this is specific, this is individual and balance is collective. Now you should be tactful enough. Why? Even specific, individual, collective, none of the bases are not applicable. Even it is in the any of the base, it is not applicable. Why? This is provision under section 10 subsection 1b Roman 8. This is disallowable expense. Did you got that point? This is disallowable expense. See the comment. Provision for impairment disallow section 10 subsection 1b 8 1608 total amount. Without any doubt you can disallow. In that, irrespective of individual impairment, collective impairment, specified impairment, any provision disallowed. Clear? Any provision, use the name of the provision. It's very clearly given in the section 10. Any amount transferred to the account. This is a notional entry which is transferred to the account. Then the next part of the question Pinnacle PLC, the company purchased 5 forklifts under 5-year finance lease agreement made on 1st October 2017 with monthly lease rental of rupees 300,000 per each forklift. What is this? This is the lease rental or a finance lease agreement entered prior to 1st April 2018. What is the treatment? Finance cost shall be disallowed. Lease in allowance should be computed. This is what? This is forklift, machineries, 1/5 of lease rentals or 1/5 of lease value or actual lease rental paid for that year, whichever is lower, you have to claim the allowance, but finance cost should be disallowed. We will see what is the finance cost for this forklift. Finance leasing interest on 5 forklift 2,500 very clearly full amount should be what? Disallowed. We will see what we have done on this 2500. See, it has very clearly disallowed. Done. Then what's the note? Finance lease interest on 5 forklifts disallow. Entered into the lease agreement prior to 1st April 2018. I have explained that. Hence, as per the section 203 of the Act and the transitional provision gazette notification shall apply the provision of Act number 10 of 2006. Now we will see how the provision of Act number 2006 we are going to apply on this. Lease in allowance on 5 forklifts, lease agreement entered prior to 1st April 2018, where it is transitional provision, 1/5 of lease value, 5 forklift, 5 years mean 5 years into 12 months, 60 months. What is the value of lease rental per month? 300,000. Then what we need to take? 1/5. That's why divided by 5. It's 18 million. Actual lease in rentals paid 300,000 into 12 for the 5 forklift 18. Then allowable lease rentals, whichever is lower, whatever, this is both same, then we will take a whatever amount. But if it is the actual lease rentals are lesser, we need to take that. Done. Okay. Then the next part of the question. What is the next part of the question? Talking about the finance cost. The bank overdraft loan balances and the finance lease payable other than lease payable on 5 forklifts mentioned in the item, the fifth item 18 above, as for 31st December 2019 was 79.774. What is given? The the lease creditor value of the 5 forklift other than the lease creditor value of the 5 forklift, the balance, all the payables are given. Why this has given? For what you are thinking? This has given not for anything, to calculate restriction on finance cost. What is the borrowing other than lease creditor? In the agreement entered prior to 1st April 2018, why it has eliminated? The finance cost of 2.5 million already we have disallowed. Then for this restriction on finance cost, this is not applicable. Then we will see for the answer. Finance, I am strictly telling you to apply this format. It's very easy for you all, as well as you can gain the marks very clearly. Finance cost, computation of disallowable finance cost. Finance cost as for income statement, I have taken these 3 from the question. If you have gone for the question, in the question, see, long term loan, short term loan interest, OD, finance lease interest on computers. These things I have taken here. This is long term loan, short term loan, overdraft interest, forklift not applicable, treated under transitional provision, finance lease interest on 5 computers, it's applicable for us, then it has taken, and total finance cost 616.5, which is the summation of all these, and then total borrowings, it has given in the question very clearly by the examiner, long term and short term loans, bank overdraft, lease liability on lease agreement entered on or after 1st April 2018, on or after, very clearly it also provided 39,774. Then we need to look at the maximum borrowing limit. What is the total? To take the maximum borrowing limit, we need to look at the total equity position. Stated capital plus reserves. This stated capital plus reserves, this information I have taken from the pre-seen, it has not given in the unseen. I have taken this from the pre-seen. Then stated capital plus reserves, stated capital 16.7 plus reserves, revenue reserve and other reserve, but don't take the revaluation reserve. Revaluation reserve is strictly prohibited to take. Then total of this, it is the 62 billion. Now we need to take the maximum borrowing limit as per what? As per section 18. Stated capital plus reserves into 3 times if the manufacturing organization. If the non-manufacturing organization, stated capital plus reserves into 4 times. What our business? It is manufacturing. Now you can argue with me, there is a service income also. But if you look at the composition of the turnover, in the composition of the turnover, I am again going to revenue note. In that the composition of the turnover, see, service income from machine tech division is only 19 million. The total all turnover on what? On the manufacturing. Then under that higher basis, I have taken the 3 times. I think you all agree with me. Then this is the answer, this 62.9 million into 3 times. Then what happened? What is my actual? Now you have to compare these 2 figures, this one and this one. You have to compare these 2 figures. Okay, in that, see, what is the maximum borrowing limit? Oh my God, 188 billion. What is the actual borrowing? 39 million. Do we have to disallow finance cost? Nothing. Now see my note, excess of the borrowing than the maximum borrowing limit as per section 8, what is the amount? 0. Then disallowable finance cost 0. Since the actual borrowing limit is below the maximum borrowing limit, there is no disallowable finance cost. Okay, done. Then, but I need to explain the finance cost separately. I will do that. Then go for the question paper. Again, we have done the finance cost adjustment. Now, happily, we are in the last adjustment of the question. Pinnacle PLC has paid LKR 18.75 as self-assessment payments for the year of assessment 1920. How this is adjusted? This is in the taxable income. It is in the tax credit, which I have put quarterly installment payment 1875. In here, this all the 4 I have explained to you, but the interest I have to take. Now we will see question again. Now take in 5 minutes what we can do. All the adjustment we have done, all the adjustment for relevant investment income, business income we have done. Now only thing we have to relook at the P&L and do the adjustment. For note 1, income statement we don't have to do anything. Revenue note, we have take the advantage of the revenue proposition. Other income, profit from disposal of PP we have adjusted. Gain from the quoted public, the gain on realization of quoted public company shares we have not adjusted. We have to go to that and see what happened. Okay, this is 175,000. Gain on realization of the shares, quoted public shares, considered as the investment income. Done. Then the next one, gain on disposal of investment in small limited, we have done the adjustment. Dividend income, rent, interest from FD, interest from treasury bill, these 4 we should need to eliminate from the business income. Why? These are considered as the investment income under section 7. See, dividend income net considered as the investment income, FD investment income, T-bills investment income. All these 3 we have to eliminate, and meanwhile we have to go for the investment income and do the adjustment at the as and when it needed, ad hoc basis we need to do that. Now rent we have done, interest on the 50,000, LRC done from fixed deposit. It's a gross given, from treasury bills also the gross income given, we have done that adjustments too. Done that adjustment, now it is completed. Again I am going to the P&L, then all the other income we have adjusted. Now under this method, if you follow this method, you are not missing a single amount of the question. Then rent, interest, compensation, sundry, all things we done. Now we will go for the expenses, salaries and wages, nothing. Entertainment, it should be disallowed, we will see that. In the business income, entertainment, yes, it's disallowed. Entertainment expenses disallowed. Section 10 1B, the 721.9, it has disallowed, completed. Then next part of the paper, donation and gift, we have adjusted. Fines and penalties, it should be disallowed, but with the assumption it should pay to the government. Fines and penalty, assumed paid to government, disallowed in section 10 subsection 1B3. If not under the, if this is not the government, but if this is not incurred for the production of income basis also, we can disallow that. That adjustment also completed. Then next one, allowance paid to manager staff adjusted, operating lease rent adjusted, gratuity provision we have to adjust 24,150, it should be disallowed. Gratuity provision disallow. Section 10 1B8, any amount transferred to the income statement. Then next one is advertising 8,600. We don't have any information relevant to advertising. Then as a student, you must put the assumption. What is my assumption? Advertising, assume that incurred for the production of income. Therefore, there is no any requirement to disallow. Done. Next one, depreciation, we should disallow 62 billion. It is under section 10 subsection 1B Roman 8. 62, it has disallowed. Done. The next one, traveling, we don't have any adjustment, then we will think it's incurred for the production of income. Foreign traveling, it's again we have adjusted that. Repair of computer done, provision for impairment done. Building maintenance and repair, we have to see that the building maintenance and repair, it's a repair part is there, then we need to adjust that. The amortization of intangible asset, it should be disallowed, which is 5,200. It should be disallowed. Here amortization of intangible asset, it is again disallowed under section 10 subsection 1B Roman 8. All the adjustments other than the repair one we have done. Then after that, repair cost of the building in 2018-19, in that actual repair in the P&L 4,260, 5% of it is building, therefore it's 5% of tax written down value as at the end of the previous year of assessment as per section 14. How I have taken this? The total amount of the cost 60, in that the 18-19, the capital allowance 3,000, the tax written down value for previous year 57, then in that 5%. Then actual repair, which is restricted to 5%, it is 1,400 and it's 2,850. The difference between the actual repair and the 5% restriction balance, if they exceed, we need to disallow, then 1410, and the same written down value adjustment we have to do impact to tax written down value. Now you are familiar with this adjustment. Tax written down value 60,000 minus 3,057,000 less capital allowances claimed in 1920. We have already claimed the capital allowance 3,000. Then for 2021 our tax written down value is 54,000. For that we have to add back the disallowable repair cost 1,410. Then we are ending up with the tax written down depreciation basis for 2021 is 54,410. Done. Completely done the question. Now business income, we have to take the total. In the exam, please do the same thing. In the minus part, allowable or minus part, take the summation separately. The plus with the profit before tax, take the summation separately, and this minus part please bring to here. Then you can have a business income. If there is a business loss, you can claim that here. I will come to finance cost and the business loss taking 10 minutes to explain that, because I need to explain it further. Then business loss after just business income after adjusting business loss is here. Now see, I have put the word in. Other than specifically mentioned adjustment, all other expenses and income considered as allowable for tax purposes. Please write this. Take 30 seconds. Write this. Then it's adding value to you. Now completely business income we have done. Then interest income, all the adjustments we have done. Then we need to take the total investment income, not the interest income, the totals of the investment income we have to take. This is the gain from realization of the land, investment asset, and quoted public company shares exempted, and the private limited company shares it is liable. Then both we have taken together, and the total investment income 2.190. It's done. Other notes done, investment income completed, business income completed. Then last one, now it's really easy, nothing to do, which is business income. Now we see the importance of the format. Business income schedule 1, we have taken 1.9 billion, investment income 2.1, we don't have any other income. Total assessable income 4,092,335, which is summation of these two. Before the question I have explained these things. Qualifying payments, deducted, explained, taxable income. We have taken after deducting 25,000. Now application of different tax rates to the taxable income. See, gain on realization of investment asset. What is the rate? 10%. Gain is 200,000. In that 10%, 20,000. Share 60,000 into 600,000 into 10%, 60. 2 capital gains tax. It's done. Then how to compute balance? Now see, total taxable income 4,067,335. In that you have to minus gains from the realization of investment asset, which is taxed under separate tax rates. Then it's altogether 800,000. Then the balance tax payable balance taxable income tax at the rate of 28% is 3,267,335 in billions. Then see the answer 20. Now can you remember why I have applied 28? We have done the test and it's not predominantly conducting business of export. Then we have applied the 28. Total tax liability, 2 capital gains plus normal tax rates. Then tax credits, we have done all these yellow colored for 5%. Only thing is on the interest, it's a 140,000 gross interest. at 5%, it is 7,000. Done that, then total tax credit is this much. Then balance tax payable or refund due, which is 789,105. Okay, I think all of you are happy. Now the question completely explained and done. This is, I am adding this. This is the final income tax payment by the Pinnacle PLC. This is the final income tax payment by the Pinnacle PLC. Now the company taxation with adjustment, explanation, all these things, the 25 marks full question has completed. Full question has completed. I am again highlighting you all, go through the relevant provision. Most of the provisions covered here. Other than the business laws, research and development, business laws, research and development, other than these two, all the adjustments covered. Even that tested, it's nothing, I am going to explain it now. Then therefore, please go through this question. This is very good question for students to attempt. Practice this, revisit the answer. The examiner has given the answer. Please go through that answer. All the documents available to you, please go through and have your knowledge for the October examination. Okay, now we will go for next part. Now the question part is end. All the requirement for the 25 marks we have done. Now I need to go for, I have promised to you after this question I am going to discuss the special discussion on section 18 and 19. Section 18 is on what? Restriction on finance cost. Section 19 is on what? Claiming of the business loss. Before restriction on finance cost, I am coming to claiming of business loss. Section 19, claiming of business loss. We will first go for the mind map and we will then come to the slide. It's taking only small time to have a mind map, then it's very easy for you all to understand the difference in the business loss, claiming of business loss. The claiming of business loss is a deduction from the business income. We will go for the business loss. This is in the section 19. I am adding business losses and investment losses both. Investment loss. Now section 19, this is business loss can be set off to business income and investment income. Clear? It's very important. Business loss can be set off to business income and investment income both. In the sense of business income, it's same business or different business lines. Different businesses. Maybe this business loss from the manufacturing, we are having business income from service, even we can claim the business loss. Then business loss can be claimed against the investment income also. This is one part. Then we will come to the investment loss. Investment loss shall not be claimed against business income or investment income. This is the main thing I need to give you all business loss can be set off against business income as well as investment income. In the different business, in the business loss can be set off against the different business incomes. And business loss can be set off against investment income, but investment loss, it shall not be claimed against the business income or investment income. We will go for that part. Section 19, business or investment losses. It is unrevealed losses from the business may be deducted in calculating income from an investment. Clear? Investment, done. Second one, unrevealed losses from an investment shall be deducted only in calculating income from investment. Investment losses shall not be claimed against business income. Okay. Here I have put shall not be claimed against investment income also. This is, I will explain in later, that provision is coming later. Then unrevealed losses from an investment shall be deducted only in calculating income from an investment. Then the loss shall not be claimed against the business income. Done. However, the gain from the realization of investment asset shall not be reduced by any loss on the disposal of another investment asset. I will change this, hence I will change this and I will take it separately. Investment loss shall not be claimed against business income, but can be claimed against investment income. I am adding that investment income other than investment income. Then special point, capital losses. Capital losses cannot be set off against capital gain. Capital gains. Capital losses cannot be set off against the capital gains. That's the summary of the investment and the business loss. Then maximum years of claiming of business loss is 6 years of assessment. Claiming of business loss, there are conditions to claim business loss. Now we will see conditions. Don't forget that maximum time period for claiming the business loss is the 6 years. Now see, there is a chart. Please refer this chart. I have given business loss, business or investment income. Here I am putting the investment income, which is the investment income. It is the other than the capital gains are not included. Then claimability criteria. Business loss as at the rate of 14% can be set off against the business income at the rate of 14%. Business loss is on 14%, business income is in 14% or investment income in 14%, you can claim. At the rate of business loss, at the rate of 28% or 40%, I will for time being, for the time being, I will remove the wording of the investment, then it is easy for you to understand what is the treatment for business income. Okay. Then in that sense, okay, then business loss at the rate of 14%, business income at the rate of 14%, then you can claim the business loss against the business income, the equal rates. Business loss at the rate of 28% or 40%, what are the companies liable under 40%? The manufacturing of liquors, then the what the Ruginos, casinos, all these things are, the gaming companies coming under 40%. Then business income at the rate of 14, business loss at the business loss is at the higher rate, business income is at the lower rate, then claimability can. Second one, business loss is at the lower rate of the 14, business income is at the higher rate of 2840. You cannot claim the business loss, and at the rate of 28 to 28 can claim. Please have this in your mind. Please have this in your mind. It is very, very important for you to know this thing, because in examination the business loss carried forward from 2018-19 can be in your paper, then in 2021 what is your treatment, you have to provide the answer. I think this is clear to you all. Then we will see in the section 18, which is the disallowable finance cost, because I need to do this under the restriction, how it is applicable and all these things I have to do. Take in 5 minutes, I will explain the deductible amount of the finance cost, deductible amounts of the finance cost. As my last discussion in the resident company taxation part, okay. Finance cost. We will do the question. For your easy reference, I have included the question. What is the requirement of the question? Compute allowable, disallowable and carried forward finance cost, if any, for the years of assessment 2018, 19 and 19, 20. Why I have taken 18, 19? Because I need to show how the unutilized amount of finance cost is going to 2019, 20. That's my objective. In the exam also, maybe examiner will provide 18, 19, this is the finance cost carried forward from 18, 19, then you should know the treatment, that's the main focus. Okay, now we will do for 2018, 19 as well as 2019, 20. In that, the Sesta Private Limited is a company engaging in business of what? Manufacturing. If it is manufacturing, what is the limitation we are taking? How many times? 3 times. And following details applicable for the year of assessment 2018-19 and 19-20 respectively. Stated capital 5 million for 18-19, 19-20 5.5. We will take this, the computation of maximum limit. We will take 18-19, computation of maximum borrowing limit. Computation of maximum borrowing limit, share capital or stated capital plus reserves, stated capital plus reserves other than the revaluation reserve. Other than the revaluation reserve. Other than revaluation reserve. Done. What is the stated capital in 2018? I am taking is a 5 million. 2019-20, 5.5. Stated capital plus reserves into 3 times, since this is manufacturing company. Then reserves 2018-19 2 million, 2019-20 it's 3 million. Done. How many times? 3 times. This also 3 times. Then revaluation reserves for both years we are not going to consider. Then here 5.57 it's a 21 million, and here 5.5 at the 3 times it is 25.5 million. Done. Then we need to go for the actual borrowing. Actual borrowings. 1819, what is the actual borrowing? Long term loan. 1819, 1920, 15 million obtained for working capital requirements. That's mean loan obtained for the production of income. Then highly we can take this as the allowable finance cost under section 12. Then this is 30 million, and here this is 15 million. Interest expense given. Now we will go for the further calculation. Actual borrowing. Now for this 1819 I will finish first. Actual borrowing, excess over maximum limit. Excess over maximum limit, how much? 30 minus 21, 9 million. Okay. Now there is excess, therefore disallowable finance cost. Disallowable finance cost, how much? Finance cost is 4.2. I am calculating here. 4.24, 30 million. Then what is the disallowable for 9 million? What is the disallowable for 9 million? It is 1,260,000. This is disallowed in the business income calculation. This is disallowable finance cost in business income computation. Is that all? No, you have to put a note on this. The finance cost note. Finance cost note. What is the finance cost note? Finance cost carried forward to 2019-20. How much? In the section 18 finance cost, very clearly given the disallowable finance cost or unutilized finance cost, you can carry it forward to another 6 years. Then for 6 years starting from 1920, you can carry it forward this 1.260. Done. 1819 all the adjustment done. Now come to 1920, which is 15 million. Now see, excess over maximum limit. There is excess. Maximum limit is 25.5. The actual borrowing 15 million, like our pilot paper. Then we don't have a amount to disallow. Now I need to take you all through to the allocation of unutilized finance cost. Unutilized finance cost. To see this, now see, this is the in the act very clearly given. If there is if we are having this hypothetical assumption, we can borrow 25.5 million, but we have only borrowed 15 million. Now see, the finance cost for 15 million, how much? The finance cost of 15 million is 2.1. If so, if I have borrowed 25.5 million, what would be my finance cost? What would be my finance cost? It is 3,570. If I have borrowed this amount, I can claim the finance cost. This is the claimable finance cost. claimable finance cost. But to claim in this 2019-20, how much we are having? Only 2.1. What is the gap from this minus 2.1 million? Further, if I have borrowed further, I can claim a finance cost of 1,470,000. How can I claim this? How can I claim 1.470? We are having a carried forward finance cost from 2018-19. At what limit? 1,260,000. 1,260,000 we have. Claimable finance cost if borrowed. Now 1.260. What is the claimable finance cost for 2019-20? 1.2 plus 1.260. Both I can claim, and my carried forward finance cost is 210. 210, which is carried forward finance cost to 2020-21 for another 6 years, including 2021, another 5 years. Done. Now, this is the amount of 2,100 plus 1,260, which is 3,360. 3,360 is my allowable finance cost, which is this 2.1 already deducted from my business income. This 1.260 allowable deduction. Allowable deduction from business income. I think with this question, it is very clear to you all what is the further treatment of the finance cost under section 18, and I am adding to this section 12. How adding to section 12? Because this given obtained for working capital requirement, only this restriction calculation we can do for the allowable finance cost under section 12, which is what are the two criteria for us to take the finance cost as the allowable finance cost. It is again, first one, finance cost shall be incurred for the production of income during the year. Second one, finance cost shall be incurred for the acquire an asset which is used for the production of income during the year. Done. Now the end of the pilot paper question. Is that all? No, I need to summarize the session what I have done today. Then we will go to the session summary. In your point, it's a learning outcome from the question. Now ask from yourself, did I learn these things? Did I learn these things when going forward with the question? If not, please go through the question, go through the answer, write, Patrice. Without your Patrice, you cannot Patrice at the examination. You shall Patrice the answer any given time, read the questions, and please have your thorough knowledge on this. We will see what are the learning outcomes from the question. Understand the computation of assessable business income with general deduction, main deductions and specified deduction with relevant section to the IR Act number 24 of 2017. Now you all having a thorough knowledge of disallowable expenses, specific deductions and the main deduction rule. Second one, understand the computation of assessable investment income from various sources. In our question, interest income from fixed deposit, interest income from treasury bills, rent income, gains from realization of investment asset as a land and the shares. In the shares also, publicly quoted shares and which is exempted and the private shares. Then application of qualifying payments as per the section 52 and the 5th schedule to Act, I have explained it. Then computation of taxable income, we have done that. Then application of various tax rates. What are the two various tax rates we have applied? 10% and the 28%. Now you have the understanding of how to compute the various tax rate, like we have divided total turnover, the export turnover divided by total turnover, all these story you all know that. Application of various tax rates to the taxable income and computation of income tax liability for the year of assessment, first schedule, referring to the first schedule. Next one, application of tax credits and computation of balance tax payable. I have explained the list of the tax credit and how it deductible and how to compute balance tax payable. And seventh one, how to read the question and how to approach to the question. In that, my main advice, start from the profit before tax and take 1 minute, read the question, the income statement notes, what as I have done. When reading, please write it's allowable or disallowable in the income statement notes. Then go for the information paragraph. In that information paragraph, start with that information paragraph, adjust to the business income. In that time, adjust to the investment income. If it is relevant to any adjustment to taxable income or tax credit, do it at that time and done that adjustment and complete. Then you all, the time, the wasting, now you are looking for that paper and the next paper, it's not good at the examination because you all are under highly pressure. Under that pressure, if you have practiced this method, it's very easy for you all to take the marks in a correct manner. Then managing of time, that's what I have explained now. Then 9, how a student interpret the answer correctly with his or her assumptions and with provisions of that. The assumption as an example for the advertising expenses, we have put the assumption, it was assumed that advertising expenses incurred for the production of income. Otherwise, please put your assumption and the importance of, finally, importance of the transitional provisions we have looked into. I think this revision session on the company taxation, it was a great help for you all to take the 25 marks question in a very good manner to attempt to the 25 marks question. I think I have done that help. Then please go through this good question and go through the answer, practice the answer, do your all the you should have a sound theoretical knowledge, gather that knowledge and well prepare for the examination of the October 2020. Okay, thank you very much for this session.